Hi everyone and welcome. In this week's episode we're going to take a look at the resurgence of the house building stocks. We also take a look at Centamin's sharp decline, our dividend cash flow, what we made for September, and the company that has acquired these unique vending machines.
Industrial vending solutions in the world.
Here we are back in a portfolio. We have 3 UK house building stocks, Taylor Wimpey, Redrow and Barratt Homes, all mirroring the same kind of momentum shift last week after this announcement by the Prime Minister.
We need now to take forward one of the key proposals of our manifesto of 2019, giving young first-time buyers the chance to take out a long-term fixed-rate mortgage of up to 95% of the value of the home, vastly reducing the size of the deposit, and giving the chance of home ownership and all the joy and the pride that goes with it to millions who currently feel excluded. We believe that this policy could create 2 million more owner-occupiers, the biggest expansion of home ownership since the 1980s.
So we can see where the agenda is and the urgency put towards building affordable homes and making it more viable for first-time buyers. Barratt, Redrow and Taylor Wimpey saw an increase of 8 to 10% in the past week. We also will take a look at Redrow's recent annual report, which highlights the effects the pandemic has had on these UK house builders, however also shows the potential for a good recovery. So this is Redrow's annual report. I'm not going to go through all of this, but just pick out the key points really. Due to COVID-19, there was a temporary closure of the sites here, which resulted in 264 completions in the final quarter of the year compared to 2,300 odd in 2019. So turnover down 37% from the year before. Also scaling back on their London business, which saw pre-tax profits reducing to 140 million from 406 million for the year. Now looking at their trading and outlook side, as a result of the group's strong sales performance earlier on in the year, the significant shortfall in legal completions due to COVID-19 lockdown, the group entered the new financial year with a record order book of 1.42 billion, up on the previous year at 1.02 billion. Also, since sales centres reopened in May, the group has seen strong demand, especially from buyers wanting to use a Help to Buy scheme and take advantage of the stamp duty holiday. So whilst low interest rates remain, the group has got a positive outlook, and they can be seen here also welcoming the government's planning for the future consultation, which we saw in a video earlier from the Prime Minister. So here we can see with Barratt that in mid-March how low the stock price fell down, all the way down to around about £3.60ish from £8.71. Most of the UK house developers have mirrored the same kind of downturn over this period. Here we can see the identical decline with Redrow. So looking at this right now could be a good opportunity to buy in at a decent value with quite a lot of upside. I've always kept my position throughout the pandemic in these companies because I've always believed that they will recover, and think they are very well priced at the moment. So over the next week or so we'll be adding more to these positions. So over to a stock that's been beaten down quite a lot in the last week, down 20% or so on their announcement of a suspension of its open pit operations in its Sakari mine in Egypt. So Centamin is a big part of our exposure to gold in the portfolio. Has been rising quite a lot in the last few years. Been waiting for sentiment to come down a little bit, to be honest, to be able to increase the stake in them. So a welcome opportunity to invest more into them, in my opinion. However, the news is a setback. It comes from a sensor detected movement in a localized area of surface waste material. Operations in the zone are only deferred. The company has already commenced a geotechnical assessment, which is focused on developing a plan to mine the impacted area. Furthermore, even if Centamin abandoned the zone, its 90,000 ounces of gold in situ is only a small part of the Sakari mine's resources and reserves. So once again, I don't want to just have the exposure to gold just in Centamin. We do have polymetal portfolio to diversify as well on gold. So yeah, great buying opportunity, and we'll be averaging more into Centamin over the next few weeks. Also, something interesting is Centamin's directors have bought more shares as the share price has slid. So that's always nice to see. It gives you a little bit of confidence that they're confident in the company overcoming this. So yeah, it's another incentive to get in at the moment, as you can see. So our average price in Centamin is around about £1.60. We're still up on Centamin as we bought them quite a while ago. That's the key thing about getting into stocks and holding them for long term. The longer you hold them, when things slide or go down in the company, the less likely you're going to feel the effects of it. We can also see that Centamin currently have got a 6% yield, which is quite nice. Then over to Big Bad Lloyds Bank, up 4 to 5% in the last week and around about 9% for the month. Lloyds CEO Horta Osario signalled that dividends could come back in 2021, as Lloyds have a solid balance sheet and could afford to do so. NatWest also claimed the same. So with that, the share price had a little bit of momentum in the past week or so. We've held on to Lloyds Bank throughout the pandemic, even though they cut their dividend. There were some really good buying opportunities throughout the last few months to get into Lloyds, and average down. It was initially around about 31 pence per share on average. So we managed to get that down quite a way. So we'll keep averaging in to Lloyds, as when they do bring back their dividend, they're meant to be paying dividends on a quarterly basis as well. Then over to Pennon Group, which is a waste and water company in the UK. We've held Pennon for a little bit of time. Pennon are down 5% this week. Their earning results are due on the 24th of November. They have had an impact from COVID, £10 million worth of impact, in line with expectations. They have sold off Redrow for 4.2 billion in July, which has helped pay down some debt. 2/3 of that debt paid already, with the amount up to 900 mil. Revenue reduced due to business and commercial water usage being down due to the pandemic. Pennon are a company that we're going to keep hold of for the foreseeable future. They pay a decent 4% yield and give us good exposure to water and waste here in the UK. Next, over to the US, we go to Snap-on, a manufacturer and marketer of tools and equipment. If you checked out the 6 recession-proof stocks video, you'll recognise this stock was one of the 6 with a high dividend safety score. That video you can find at the above link here. Now, the reason for the 9% rise could be due to this acquisition on the 28th of September for 36 million. Here's a look at AutoCrib.
AutoCrib's history of innovation and unrivaled reliability has made it the most trusted name in industrial vending. For over 20 years, we built and assembled our products in the USA. Utilizing state-of-the-art design and manufacturing processes, AutoCrib has developed the most dependable and advanced industrial vending solutions in the world. No matter the size, shape, or quantity of items, AutoCrib has the world-class asset control solution your business needs to maximize productivity and cut costs. AutoCrib. Capacity, speed, flexibility.
Quite impressive, right? Let me know in the comments what you think. I mean, you're not going to keep Mars bars and Snickers in there, but there's potential, so we'll keep an eye on it and see what happens in the future. So as a whole, we're up around about 21% on Snap-on, with £21 in the green, and they pay a 2.9% dividend yield, which isn't great, but you know, we'll live with it with their stability and growth. Next we go over to Cisco, up 7.5%. We take a look why. Cisco was awarded a contract with the Pentagon for 800 million for full line of food distribution. So quite a big contract there, and has seen the share price rise. Currently we're up 25% on Cisco. They don't pay a great yield, especially having to pay the tax over here in the UK as well, but we're going to keep hold of them for the long term, and might add to the position in the future. Now we're going to take a look at September's dividend income. So we got dividends from Pfizer and Visa, Honeywell and Pennant, Johnson & Johnson, IBM, Microsoft, Raytheon, Snap-on, ExxonMobil, Ashtead, Centamin, 3M, Realty Income, McDonald's, Duke Energy, Rio Tinto, Home Depot, Unilever, Waste Management, Shell, Legal & General, Bank of America and Polymetal. So as you can see, quite a strong month for dividends in September, and we'll have a look at the outcome as a total. So this is our dividend cash flow chart, which we've been tracking for quite a few months now. So we can see that September was our highest month. So we received £24.10 in dividends. So we know that September traditionally is one of the highest months for dividends. So don't expect the same kind of amount next month. But it's trending in the right way, which you can see from the trend line. So yeah, very good month for us, and looking forward to seeing the distance we can make on this by next September. Okay guys, now finally we're just going to quickly cycle through the portfolio just to see where we're up the most and which positions we're down in. So 3M we're up 14%. We can see Ashtead here we're up 64%, investing in them since April. We are down 8% in British Tobacco. Caterpillar we're up 35%, Cloudflare we're up 18%, Comcast 17%, ExxonMobil we're down 17%, which I believe is the most in the portfolio. Honeywell we're up, Illinois Toolworks we're up 28%, Leggett & Platt 54%, McDonald's 16%. We are down 9% on Norcross, Pfizer down 5%. We're up on Realty Income 13%, Redrow 11%, Rio Tinto 31%, Snap-on 19%, Cisco 24%, Texas Instruments 24%, and Walt Disney 18%. So they're the stocks that we're up and down with, not down by a huge amount, which does help across the portfolio. Some of these stocks I will be trying to get out of, to be honest. Carnivore and Exxon, we don't hold massive positions at all in those stocks, but I don't want to sell out until we're in the green. It's not going to take much to average into those stocks at all, really, which I'm grateful that I haven't invested heavily into them at the time I bought in. So that's what we'll be doing. The orders that have gone through in the past few weeks literally have just been averaging down on the stocks that we have already in the portfolio, and that's really it. So once again guys, thank you for joining. Feel free to like and subscribe if you enjoyed the content, and hopefully I'll see you next week.